Hey there, everyone. Ready to dive into some ETFs?
Always ready.
All right. Well, today we're looking at SPYI, SPYT, and ISPY.
Interesting choices.
Yeah, I thought so. They're all going for high income from the S&P 500.
So income-focused investors. Got it.
Yeah, exactly. And they all use covered calls to make that happen.
Oh, that's right, the covered call strategy.
Yep. So before we get into the nitty-gritty of each ETF, what are some of the big things people should think about when looking at ETFs like these?
Well, first off, you got to know your own risk tolerance.
Okay, risk tolerance makes sense.
Right, because some of these ETFs, like SPYT, they're aiming for crazy high yields.
Yeah, over 20% and saw that.
But that comes with trade-offs.
Yeah, good kind of trade-offs.
You might be giving up some potential upside for that big income stream.
So it's not always just about chasing the highest yield.
Exactly. It's all about balance, right?
Right, balance.
You also got to look at expense ratios. Those fees can really eat into your returns over time.
Oh yeah, those fees can add up.
And of course, tax is super important.
Tax efficiency, got it.
We'll break down how each ETF handles those things as we go along.
Sounds good. Now let's start with SPYI, the NEO's S&P 500 High Income ETF.
Okay, SPYI.
They're boasting a 12.04% dividend yield, and they say they're super tax efficient.
12.04%, not bad at all.
So how did they pull that off?
Well, they use SPX index options, which get some pretty sweet tax treatment under IRS rules.
Oh, interesting. I didn't know that.
Yeah, 60% of any gains are taxed as long-term capital gains, no matter how long they hold the options.
So that's a potential plus right there.
Definitely. And they're actively managed too, right?
They are, yeah.
So SPYI's managers can actually harvest losses to make things even more tax efficient.
Oh, so they're actively working to lower the tax burden. Interesting.
Exactly. It's like they're taking advantage of market swings to your benefit.
That's pretty cool. But their expense ratio is 0.68%. Isn't that kind of high compared to some others?
It is a bit on the higher side, yeah.
So investors have to weigh that against those potential tax benefits.
Exactly. Always got to consider the trade-offs.
Right. Always. Okay, next up is SPYT, the Defiance S&P 500 Target Income ETF.
Okay, SPYT.
Now, their dividend yield is a real eye-catcher, 20.1%.
Wow, that's ambitious.
I know, right? But how sustainable is that? I mean, I gotta be a little skeptical.
I hear you. To get that yield, they're using daily credit call spreads on the S&P 500.
Daily credit call spreads, huh? Break that down for me.
It basically means they're selling a call option at one price and buying another at a higher price.
Okay.
It's a way to juice that income, but it limits how much they can gain if the market goes up.
So they're kind of betting the market will stay within a certain range.
Yeah, you could say that. If things take off, they might miss out.
That makes it seem riskier than SPYI, right?
Yeah, I'd say so. They're taking more risk to try to get that higher yield.
And it's brand new, right? Launched just this past March.
Yeah, so not much of a track record to go on yet.
Plus that 0.87% expense ratio, even higher than SPYI.
Yeah, that's something to consider for sure.
High yield, maybe higher risk, and higher fees. A lot to think about.
Definitely a lot to unpack there.
All right, let's move on to our last one for today. ISPY. The ProShares S&P 500 High Income ETF.
Ah, ISPY. Interesting one.
So they're trying to track the S&P 500 Daily Covered Call Index, but they do it through swap agreements.
Swap agreements, huh? That sounds a bit complicated.
Yeah, a little bit. I mean, basically, it's like they're making a deal to get exposure to those daily call options without actually trading the options themselves.
Trying to picture that.
Think of it like, well, let's say you have a bunch of baseball cards.
Baseball cards. Okay, I'm listening.
And you think some of them are going to be worth more later on.
Like they'll go up in value.
Right, so you could just hold on to them, hoping to sell them later for a profit.
Makes sense, like a regular investment.
Now, imagine you find someone who'll pay you a steady income
Okay, steady income.
in exchange for getting the profit if those cards go up in value.
So they get the potential upside, and you get the guaranteed income.
Exactly. That's kind of like the swap agreement in ISPY.
Ah, I see. They're swapping potential stock gains for that income from the covered calls.
Exactly. ProShares thinks this way can give you consistent income while still letting you make some money if the market goes up.
Interesting strategy.
Yeah, it's kind of a middle ground between SPYI and SPYT in terms of risk and reward, I'd say.
Makes sense.
Their dividend yield is 5.8%, so lower than the other two, but still pretty good.
Yeah, not bad at all.
And their expense ratio is right in the middle, too, 0.55%.
So potentially a bit more balanced, huh?
That's how it seems, yeah.
But we got to remember, past performance doesn't guarantee anything in the future.
Right. Always got to keep that in mind.
It's all about finding the right fit for your situation.
All right, so we've got SPYI, the tax-efficient active manager, SPYT, going for those big yields, and ISPY trying to find that balance with its swap agreement.
3 different flavors of covered calls, huh?
Yeah, it's fascinating how they all use the same basic idea in different ways.
It really shows how diverse the ETF world is.
Exactly. But we're just scratching the surface here. In the next part, we'll dig deeper into the risks and rewards of each approach and how they might do in different markets.
Sounds good. Looking forward to it.
Yeah, we've got a lot more to unpack.
Absolutely.
All right, welcome back, everyone. We've been talking about 3 S&P 500 ETFs, SPYI, SPYT, and ISPY.
Yeah, all using those covered calls to try to pump up the income.
Exactly. Now, I want to get into something I was thinking about.
Okay, sure.
How do these strategies actually play out in different market conditions?
Yeah, that's the million-dollar question.
Right. Like, what if the market tanks or suddenly goes through the roof?
Well, covered calls, they kind of shine in sideways markets or slightly bearish markets.
Okay, so like not too much movement up or down.
Yeah, think of it like they've got a built-in cushion, you know?
A cushion. I like that.
You might not get all the gains if the market goes way up, but you're also sort of protected if things go south.
Interesting. So if I'm expecting a lot of ups and downs, these ETFs could help smooth things out a bit.
Possibly, yeah. But you got to remember, always a trade-off.
Oh, right. There's always a trade-off.
If the market's going up, those covered calls might hold you back.
Because you're giving up some of that potential upside to get that steady income.
Exactly. So you got to match your ETF to what you think the market's going to do.
All right. So let's say I'm all in on covered calls. How do I pick between SPYI, SPYT, and ISPY? What really sets them apart?
Well, the big difference is how much risk they're each taking on.
Risk. Got it.
SPYT. That one going for that huge 20.1% yield, that's the most aggressive for sure.
Makes sense. They got to do something risky to get that kind of yield.
They're using those daily call spreads we talked about, which can boost gains but also losses.
Yeah, so someone who likes SPYT is probably okay with a little more volatility.
Exactly. They're probably after that maximum income, even if it means bigger swings.
Okay, so higher risk, higher potential reward. Now, what about SPYI?
SPYI is playing a bit more of a long game, you could say.
Yeah, they're all about that tax efficiency.
Right, but their fees are higher, 0.68%. That's not nothing.
Do you think those tax benefits make up for that cost?
Well, depends,
On what?
If you're in a high tax bracket, those savings could be worth it.
Oh, right. Makes sense.
Got to crunch those numbers and see how it works for you.
Always got to do your homework. Now, where does ISPY fit in with all this? Their strategy with the swap agreements seems a bit more, I don't know, complex.
Yeah, ISPY is kind of like trying to find a middle ground.
Right, a middle ground.
Steady income through those daily covered calls, but using the swaps to do it.
Like our baseball card example.
Exactly. They're trading some potential stock gains for that guaranteed income.
And their dividend yield and expense ratio are right in between the other two?
5.8% yield, 0.55% expense ratio, yeah, right there in the middle.
But they're pretty new, right, like SPYT.
Yeah, so we don't have a long history to look at yet.
So got to be a little cautious, see how they handle different market ups and downs.
Absolutely, past performance doesn't tell the whole story.
Okay, so a lot to consider. Now, I know you like using those comparison tables to see how things stack up.
Oh yeah, that can be super helpful.
We've got one in the research materials that breaks down the key stats for each ETF.
Right, side-by-side view, easy to compare.
Let's start with those expense ratios. ISPY is the lowest at 0.55%. SPYT's highest at 0.87%.
That's almost a 0.3% difference.
Yeah, and over, say, 10 years, how much could that difference actually matter?
Fees compound over time,
Yeah, but I'm not sure I really grasp how much of a difference it makes.
Let's just say if the S&P 500 goes up 7% each year, over 10 years, that 0.3% difference in fees could easily be thousands of dollars difference in your returns.
Wow, okay, that puts it into perspective.
Those little numbers can have a big impact over time.
Okay, fees checked. Now, dividend yields. This is where things get interesting.
Yeah, huge difference there.
ISPY at 5.8%. SPYT all the way up at 20.1%.
It all comes down to that risk-reward balance we were talking about.
Right. SPYT is going all in for that big yield, but they're taking on more risk to do it.
Exactly. They might miss out if the market takes off, but they're getting that income no matter what.
Gotta admire their boldness. Okay, last thing, performance history.
The track record.
SPYI has the longest one, going back to August 2022.
Yeah, they've been around a bit longer.
How have they done compared to just holding the S&P 500?
pretty well, especially when the market was flat or down a bit.
But if the market's booming, they might fall behind, right?
Could happen, yeah. Those covered calls can limit how much they gain.
Okay, makes sense.
Yeah.
And SPYT and ISPY, well, they're too new to really judge yet.
Yeah, not enough data to go on.
Gotta wait and see how they do over time.
Exactly. And remember, past performance doesn't tell you what's going to happen in the future.
All right, good reminder. Well, we've covered a lot today.
A lot of ground, yeah.
All about those covered call ETFs, SPYI, SPYT, ISPY, how they work, the risks, the potential rewards.
And most importantly, how to choose the right one for you right.
Absolutely. It's not just about chasing the highest yield. It's about matching the ETF to your goals and your risk tolerance.
Could have said it better myself.
So, before we wrap things up, I want to leave our listeners with something to think about.
Okay, I like where this is going.
We've talked about all the pros and cons of covered calls, but what do you think is the biggest misconception people have about ETFs like these?
Biggest misconception. I think it's that high dividend yields are always a good thing.
Oh, yeah, I can see that.
People get so focused on that number, they don't always see the risks or the trade-offs.
It's tempting to just go for the biggest number, but as we've seen, it's not that simple.
Nope. Got to look beyond the surface, understand the whole picture.
Right, so before you invest in anything, do your research, understand the strategy, and make sure it fits your plan.
Couldn't agree more.
Wow, we've really dug deep today.
Yeah, we have, haven't we?
From those covered calls to SPYI, SPYT, and ISPY.
It's been quite a journey.
And I think the big takeaway is that picking the right ETF isn't just about grabbing the one with the highest yield.
Absolutely not. It's about so much more than that.
It's about finding that ETF that matches your goals, your risk tolerance, how you see the market playing out.
It's like, finding the right tool for the job.
Exactly. So as we wrap up, what are some of the key things you hope our listeners will remember?
Well, I think the most important thing is do your research.
Research. Always good advice.
Don't just go by the headlines or those big flashy yield numbers.
Yeah, gotta dig deeper.
Read those prospectuses. Look at those fact sheets. Watch those videos.
And remember, we're just giving you a starting point. There's so much more information out there.
Yeah, it's up to you to keep exploring and make those smart decisions.
Investing is a journey, right?
Absolutely. It's not just a one-time thing.
Keep learning, keep asking questions, and keep adjusting your strategy as you go.
And, if you're ever feeling lost, don't be afraid to reach out to a financial advisor.
Oh, yeah, good point. They can be a huge help.
Especially when it comes to those big decisions.
So as we close out this deep dive, I want to leave everyone with one final thought.
Okay, I'm listening.
Investing can seem kind of scary, but it's also really empowering.
I like that. Empowering.
It's about taking charge of your financial future, making smart choices, and building a portfolio that works for you.
It's about taking control.
Yeah. And it's okay if you don't get it perfect right away.
Nobody starts out as an expert.
Just start that journey, keep learning, and make adjustments along the way.
The key is to stay curious, stay engaged, and stay focused on what you want to achieve.
So keep exploring, keep learning, and most importantly, keep investing in yourself.
Well said.
Until next time, happy investing, everyone.